So SG Voices, what is it? But we are your go-to resource for connecting industry leaders, such as yourself, with access to trusted educational content and help you discover valuable insights that can help you drive your businesses forward. Our mission is to empower you with relevant and actionable knowledge tailored to the challenges and opportunities that our industry faces today. As we move forward with today's webinar, I'm really excited to have an expert panel of people in the M&A space as well as the legal space. We're doing our annual webinar with Matrix Capital Markets Group. We have Spencer Cavalier, who's the co-head of Matrix Capital Markets Group, and Sean Dooley, who's a managing director there. And they're going to be speaking a little bit about what's going on with M&A activity in our industry. They'll put a focus on retail and wholesale fuels, propane, as well as lubricants distribution. These slides that are going to be shared today are going to be left behind for you. They're going to move quickly through the slides, but there's some really great information in here that will be sent out to you afterwards, as well as this webinar will be recorded, and that'll be sent out to you after as well. After Matrix goes, we'll have Winthrop and Weinstein talk. We have Jim Dierking, who's a shareholder at Winthrop, and then Noreen Sedgeman, who's a shareholder as well. They're going to be providing just a legal update on business succession planning, things that we should know, management succession, as well as ownership succession, and tax considerations along with it. So it should have a really good combination of presenters here today. We want this to be as educational as possible for you. If you have questions, you're on mute, but please type those into the GoToWebinar framework. I can see those and read those questions, and I'll relay them to our speakers as we get moving. We want this to be high impact for you, and we're really grateful for these speakers. Just a brief bit about Matrix. I'll share more about Winthrop later, but Matrix is kind of the gold standard in M&A activity in the downstream energy and convenience retail segment. Regarded as a national leader for their advisory services that they provide. They touch on a lot of different aspects of downstream energy, distribution, terminaling, convenience stores, and other petroleum marketing segments. And they're committed to helping you maximize your value through customized, detail-driven transaction processes. Thank you, Spencer. Thank you, Sean. Let's dive on into the content right now. Spencer, I'm going to turn the floor over to you to talk about what trends are taking place in M&A activity.
Thanks, Jed, and thanks for having us back again this year. We're always flattered to be on here, and we have really happy to be with Jim again, and Noreen is joining us for the first time, so that'll be great. They've got some good content also with succession planning, so we're gonna enjoy that. So we like to cover a lot, and so we're gonna go with pace, but these slides will be given out, like Jed said, to everybody, and we're always around for questions from anybody, after the call. So Sean, let's go to slide 3. And this is what we're going to cover. It's kind of a similar approach. We're going to look at M&A activity from all sectors, and then we're going to drill down into the industries that we specialize in, and everybody is interested in on this call. So, and then we'll go down to the legal update and hit Noreen and Jim's section. So on the next slide, this is high-level M&A in the U.S. for 2025, all sectors. And what we do here on this graph is we chart out the number of deals, deal count, and we're looking at deal value as well. So the blue bars is deal value, and the dotted lines or line with that breaks is deal count. And you can notice that the deal count has two, it kind of forks. So we have the actual deals that were announced, and then we have deals that are estimated to be announced, because that seems to be more accurate when you go back in time to see what was really getting done but not announced. So PitchBook is the source of this. They've done a really good job of going back and figured out how to make the data more accurate. And so if you look at the number of deals in 2025 that were completed or announced or about to be announced relative to 2024, activity was up, and so was deal value. Deal value was up every quarter, and but I'm going to show a graph in a second, but you'll notice that Q3 and Q4 were up significantly more. And that is because of the passage of the One Big Beautiful Bill. I think that really drove some bullishness into the M&A markets and helped get a lot of deals that were kind of on a slower, normal pace to accelerate because people thought they could, buyers could get better returns on, a lot of the provisions that were in that bill. And we'll go over those in a minute as well. So that's really it for this slide. Let's go to the next slide here. And then this is the story of 2025 relative to prior years. So this is U.S. private equity deals by value range. And this, there's so much private equity activity. This gives us a good snapshot of transactions, at what type of deals were getting done. And you can notice that in 2025, it was predominantly transactions over $1 billion. So the 52% is usually in the 30% range, but it was 52.4% last year. And then the other buckets, the less than 25 through $500 million, those percentages were lower than prior years. So there was a little weakness kind of in the middle market, lower middle market, and a lot of strength in the in what I call the higher markets or high value transactions. So most of the deals done in our industries are frankly between 25 and 500 million, at least the deals that we do at Matrix. And you can see that that's our industry deals. This is a private equity chart, but you can see activity just in private equity overall was less in those bucket size of value. So it's very interesting. And in our industry, though, it was kind of similar. And we'll go to deal count here in the middle in a minute for our industries, but we had some large transactions, right? We had Sunoco buying Parkland for $9.1 billion. We had Circle K buying Giant Eagle for $1.6 billion. Chevron bought Hess for $53 billion. Racetrack bought Potbelly for $689 million, which is a little bit different. But so you saw we had some big deals last year, and that it was kind of similar to the private equity data. So let's now drive into the industry data. And in the next slide, you'll see, go one more slide, thanks. So as everybody, a lot of people know, these are the industries within the downstream energy and convenience retail sector that we cover at Matrix. It's propane, lubes, terminals, bulk heating oil, petroleum transportation, but petroleum marketing, convenience retailing. So in this presentation, we're going to hit mostly on petroleum marketing, convenience retailing, propane, and lubricants. But in this current section, we're going to talk about petroleum marketing, wholesale fuels, and convenience retailing. So on the next slide, I think there's a lot of people that are familiar with this. Many of the webinar participants that come year after year, we like to talk about the factors driving consolidation, and those that are permanent and those that are subject to change. And I'm not going to hit every one of these. We're always updating these, but I'm going to hit on 3 of the ones that are likely permanent. And the first one I'll hit on is the second bullet, and that's the continued expansion by recognized C-store brands with big loyalty programs and large format stores. And I'm seeking data on the number of NTIs that are happening, but more and more of the larger brands are choosing. I'm not talking about Casey's and Circle K. I'm talking about strong regional brands, the Wawas of the world. They're choosing to build NTIs. They want their own prototype store, and they have different sizes of prototypes, but they want a very consistent storefront and full court, back court, and they want their great loyalty programs to work for everybody. And they're making a big impact. And these brands are, a lot of our retailers in the industry have created their own brands and create incredibly nice formats. So we're seeing more of those pop up, and that's affecting M&A a little bit, but the NTIs are really growing, and we're going to put data together to show the growth of just NTIs in the industry versus this resale of traditional convenience stores that are out there. So we'll have that hopefully next time we meet. The next bullet I want to talk about is the ability to attract and retain employees. These larger brands and these stores that are or chains that are very cash flow positive, you know, they're offering better benefit packages to a lot of their employees. 401k matches are higher, training's better. So we're hearing a lot of pressure from some marketers out there that they're losing employees to these larger chains. Now, sometimes they're getting employees back because some employees like to be in smaller companies, but for the most part, the bigger brands are attracting talent, and it's putting pressure on some of the smaller chains out there that we've seen. So we've heard that. And then the last bullet that we think is going to be permanent is that while there are some places in the country that same-store sales or same-store volumes for fuel, I should be saying, increased, on the whole, same-store fuel volumes have gone down, and they've gone down for 2 years in a row at around 3 and 4%. And it's, we're going to talk about the pause and the electric vehicle adoption. Okay, but it's still out there. It's really the increasing efficiency of the internal combustion engine vehicle and the use of hybrids, traditional hybrids. And that's really cutting volumes in certain markets. It's having a negative effect. So we'll see how that continues on. We hope it kind of pauses, but it has been becoming a trend here over the last couple of years. Factors that are subject to change, it's really, the top two is really what I want to talk about, and that's we are at, the lowest level tax-wise in the history of our country, and it just got better with the OBB, or the Big Beautiful Bill, however you want to say it. So we don't think that's going to be around forever, and it's something that I think that's overlooked. A lot of people go, maybe I don't want to sell or I don't want to buy. We don't know what the situation is, but these two things affect both buyers and sellers. The Big Beautiful Bill is wonderful for buyers, and the historical tax rates being so low is wonderful for sellers. So it's a win-win, and we think that'll change in the future. And the last one that's going to subject to change is that we are seeing a lot of workers go back into the office. That had a negative effect on, same-store sales for a lot of retailers and fuels distributors as well. I just met with a couple of retailers out on the West Coast. They're talking about their traffic counts are coming back this year. They're way up, their volume's up, because they had really been depressed because a lot of California companies did not require workers to come back to work until mid last year. So a lot of people were working from home, either full-time or 3 or 4 days a week. So I think that's a positive for the industry. On the next slide.
Real quick,
Sean,
on the One Big Beautiful Bill, Spencer, you had mentioned favorable tax treatment. Are there other aspects of that are attractive to buyers?
Well, the interest deduction percentage that you can deduct, how they're measuring how much you can deduct, for example, has gone up as well. It was based on EBIT, now it's based on EBITDA. So that makes it a bigger percent. You can take a percentage against EBITDA versus EBIT. I think that's one of the biggest impacts that we're seeing. If you're smaller and you're a C Corp, there's the 1202. They've expanded how much of the tax you can get for, not pay taxes on. And it gets complicated. I don't have time to go through it all, but I think that's another really nice thing. And then there's some other nice provisions as well. But nothing is better
about the EBITDA, because the depreciation acceleration is now, back to that 100% in year one on qualifying assets. And so if it's tied to EBITDA, that EBITDA is going to be a bigger number. Right.
Well, yeah, and just to be clear, I was talking about how much interest you can deduct on debt, right? It's more tied to EBIT. So, but you're right. Qualified property that you can write, it's not only current, it applies to everything. So if it had been an older property, not a new asset, you can write off the whole thing. That's the twist in the new bill, in addition to being 100%. So anyway, I can get into it more if you'd like, but those are the kind of the nuances of the Big Beautiful Bill. That's wonderful for acquirers and builders right now.
Thank you.
Yeah. So the next slide, Sean. Look, everybody asks about M&A activity by quarter. So this is a table and graph we like to keep. Our criteria is that the transaction had to have at least 10 convenience stores or 25 supply accounts or 2 truck stops, and sell leaseback transactions are not included. Convenience stores and fuel distribution had to be the majority of the type of business that was sold. And so you can see since 2016 through 2025, the average number of transactions per year has been 32 for fuels wholesalers and convenience retailers. And then I'm gonna say that the average has been 36, and there were 32 in 2025. And if you look down at the lower right table, underneath the 2025 column, you can notice that kind of consistent with overall M&A for the whole country and all the sectors, the activity increased in quarters three and 4. So it really we were kind of concerned about the number of deals in the first half of 2025, but the activity went up again at the end of 2025. So it was about 4 transactions below normal. But that happens, and I don't think we're going to get back to 57 in 2021, but I think activity is going to be strong, especially with these tax benefits for both buyers and sellers that we are the beneficiary, that will benefit from, everybody. So on the next slide, we'll talk about multiples. Everybody asks about the multiples, and just the caveat, everybody needs to remember that the companies that comprise this graph are publicly traded companies, and this multiple is a corporate level enterprise value divided by corporate level EBITDA. So a lot of people will hear multiples at an asset level. My retail chain sold for a blank of just store level EBITDA. Okay, that multiple is going to be lower than what's on this chart. This one is corporate level EBITDA. This has all the expenses, all the corporate overhead, everything in the denominator. So you're going to have a higher quotient that comes out of it. So this is how people look at public companies. We like this table because it shows a trend of multiples over a long period of time. And you can see from 2016 through Q3 of 2025, the average has been about 9.9 times for the public companies that were trading through these quarters. If they were actively trading in the quarter, they made this long-term trend. So it's been strong. It has gone up recently, and a couple of companies are really driving it, and that's Casey's and Circle K. They help lift the multiples up a good bit, but overall, the publicly traded companies are healthier than ever. And I think there could be Arco just took another public company public last week, I believe it was. They started trading, and then I expect that there could be 2 or 3 more publicly traded companies that have their S1s out there and they're working to go public. It's common knowledge. So there could be another 3 companies that could be public by the end of 2026, and that's good because it creates, for those that are thinking about selling or whatever the case may be, there's more liquidity and more drive by these public companies to grow. So it's totally different, Jed, than when we started a long time ago.
Spencer and Sean, one of the things I find interesting about this graph is you can see the elevated publicly traded multiples on the right, but that's been a period when interest rates have been largely increasing. And there's been concern about, hey, what happens when interest rates go up? They've been low for so long. They're still comparatively low, but higher, but valuations have held firm.
They held firm because interest rates these are strategic buyers. They're not like private equity buyers that are so sensitive to interest rates. These companies are taking a much longer term view. They can get a lot more synergies. The synergies are outweighing the increased cost of the interest. And so they're remaining, if they want an asset, they're going to go for it and try to buy it. So, the interest rates didn't increase enough to stop to outweigh the benefits of the synergies that these companies get when they do acquisitions. Now, these are public traded multiples, but they do imply a higher multiple for acquisitions.
Mm-hmm. What's your outlook for 2026, Spencer? You can think these trends will sustain?
I think they will. Yeah, I think we're going to have a good 2026. So, barring some type of war or some type of issue with oil in the Middle East that we're worried about today in the press, but I think things will go well. So there's a little concern about inside sales, Jed. I mean, there's some pressure with a lot of the marketers, and Sean's going to hit a slide here in a little bit. Same store sales are down for many of the marketers, or there's a little bit of pressure. So, and that's just due to inflation and discretionary money for the general consumer. So we're not without some concerns, but the overall environment is strong. Okay, so we go on, Sean. And then this slide here, we want to just hit on, and I think we touched on this last year, but we have seen the interest, demand, and the valuations for wholesale fuels businesses. We're talking about, branded fuels, dealer contract businesses, unbranded contract businesses, things of that nature, but mostly branded. People have become more interested, and primarily because it's a low cost, or not low cost, but a lower fixed asset investment for a pretty good return, especially to help with fuel procurement. So if fuel margins are so important today. There's a study by NACS that say most marketers they wouldn't survive without fuel. They don't make profit on the inside. And we're going to do a study of that because we want to drill down and to do work a little bit. But I think they're probably right for the most part, especially for smaller regional guys that don't have a strong inside presence. So a lot of people are seeking to get better fuel procurement so they can increase the margins outside. And they're going to continue to see that. And a lot of these larger retailers or fuels distributors, they have much better buying index deals. And then they're selling to dealers or commission agents that's at a posted rack price. So their margins have expanded. And so when those companies are looking at smaller fuels distributors to acquire, they have a built-in synergy just on procurement. And so that's expanded the multiples that buyers are willing to pay for wholesale fuels businesses today. Now that doesn't include commercial account to the end users and stuff like that. We're talking about purely retail, wholesale fuels distribution to retail in this situation. So this was kind of out of favor for a while. Like, people wanted to focus on one thing, but now fuel procurement is so important. They're very much refocused on it. Okay, Sean, you can take it.
Sure. So on slide 12 here, the top half of the slide, we've graphed the national average fuel margin in gasoline cents per gallon over the last decade. So going back to 2015, you see that roughly 20 cents per gallon, and then it's nearly doubled to 40 cents per gallon in 2025. And you can see that there's been a nice baseline the last few years, which is relatively equivalent with the post-COVID time period. So if you see the COVID time period, 2020, 21, big increase from 2019, a further increase in 2022, and then it's leveled off a little bit, but consistent with that period coming out of COVID, just not the peak post-COVID. That's what we've observed. The bottom half of the slide, we've graphed gasoline gross profit in terms of an index base. So if you look at it, if you think of it as $1 of gasoline gross profit in 2015 and $1 in the CPI index, which measures inflation, that dollar would have grown to $1.80 in 2025 and just about the same in 2024. And inflation's up 30% from $1 to $1.30 in 2024. The inflation data for 2025 hasn't yet been released to make this apples to apples. But if you go back 1 year from 25 to 24, you can see it's roughly in line. So what does all that mean? That means roughly over the last decade, gasoline gross profit has doubled inflation, moving at a CAGR, or compounded annual growth rate of 6% versus inflation at 3%. So you can see it's outpaced inflation by roughly double. Here on slide 13, moving from fuel margins to what might be impacting fuel volume, we have graphed battery vehicles, plug-in hybrids, and hybrid vehicles. And these are percentages of new vehicle registrations. So moving to the bottom left of the graph, you see the battery electric vehicles And those have roughly leveled off at about 9% of new vehicle registrations. And it's been relatively flat 8 to 9% for the last 3 years, 23, 24, 25. Similar trend with plug-in electric vehicles. That's been roughly 2% of new vehicle registrations the last 3 years, and actually slightly down year over year from 24 to 25. Different story in hybrid vehicles. These are the more traditional hybrid vehicles. We've seen increases here from 10% in 23 to 14% in 24 to 17, 18% in 25. So that's the share of the hybrid vehicles that's increasing and putting more pressure on fuel volume. Spencer mentioned some of the public companies anecdotally, and then the ones that were included in the enterprise value to EBITDA multiple graph that we had prior. So here we've graphed Circle K, which is Couche-Tard, in the top half of the slide, and then Casey's in the bottom half of the slide. I'm going to speak to the left-hand side of the slide, which is the change in inside sales first, and then I'll speak to the right-hand part of the slide, which is the change in fuel volume. So you can see Couche-Tard hit a little bit of a rough patch in late 2023, roughly third, fourth quarter of 23, where you see the inside sales go from the green bars, which is positive quarter-over-quarter growth, to negative quarter-over-quarter growth with the red bars. That lasted a little over a year until the first quarter of 25, where it turned positive again. If you contrast that with Casey's, down below, you see Casey's was green during that time period and really green all time periods except for one quarter in COVID. Casey's has really been a shining star in the industry, as people have probably seen with their earnings reports and stock price. Over on the right-hand side, a little different story with the change in fuel volume. Roughly similar stories. Maybe they're off a little quarter or two in terms of growth trends or declines between Couche-Tard and Casey's, but they're following a much similar pattern in each other in fuel volume, which is a little different story than the inside sales we looked at. The other item I would point out in terms of inside sales is this is based upon real dollars, so includes inflation. So if you think inflation's been running at roughly a 3 to 4% rate, inside sales increasing at 3 to 4% is simply keeping up with inflation. If you're less than that, then your real inside sales are moving down. In terms of a few other public companies, we've graphed Murphy and Arco GPM in the same data as we saw with Casey's and Circle K. So left-hand side of the slide is the change in inside sales. Similar story for Murphy and Arco as Circle K. Some tougher quarters in third quarter 24 through third quarter 25. You can see those red bars. And then fuel volume for Murphy, relatively similar to Circle K and Casey's on the prior slide, with some declines during the COVID period, followed by rebounds and some more recent declines. Again, these are quarter-over-quarter measurements. And then Arco has been down a bit more, a little tougher patch, basically down quarter-over-quarter in terms of fuel volume. So fuel volume is the red and green bars, and then you can see the blended fuel margin, which is the line graph in blue.
It's interesting, Sean, on these trends, thinking through our study group member data. I was just looking at it with the group last week, and inside sales, our study group members are up for calendar year 2025 about 3%. So maybe a little bit stronger than this, not as strong as some of the firms in here. And gallons, even though I know the national trend has been down a few percentage points, actually been a shining star for our members. They've been up about 2%. Wow. But it almost feels like, flat's the new up, right? Like, just keep up with inflation. This last year, you've been doing okay.
Yeah, agreed. And I think if you were to look at study group members, again, vis-a-vis some of the public companies, Circle K and Casey's up a little bit, Murphy and Arco down. So that's good to hear that the private companies are beating some of the public companies in that regard. Last graph here on inside sales. So we've taken a little longer look back period here and not graph quarter-over-quarter changes, but a cumulative change. So reaching back to first quarter 2020, and this would be similar to the inflation chart we looked at with fuel gross profit. So if you think about 0% or $1 here, and then where it would go after or to the third quarter of 2025. Again, you can see Casey's the red line. We graphed that at the top. Again, the shining star up 30% during this time period. And then you see Murphy, Circle K, 7-Eleven, all in double digits, call it in the teens. And then again, Arco, a little tougher stretch here. They're the one outlier, down 7% in the same time period. And this is cumulative same store inside sales we're looking at here. Speaking about earnings reports and quarterly releases, here we took a few quotes, excerpts, if you will, from semi-recent earnings calls. So I'm not going to read these word for word for you. Feel free to do that when you get the actual slide deck. But just a few highlights here. Andrew Clyde of Murphy's talking about how structural changes in fuel margin, namely higher, has been observed. Alex Miller of Couche-Tard talking about how they've seen performance in their portfolio vary dramatically depending upon which region you're analyzing. Charles Nifon and Cross America Partners comparing their same store volume versus national data. So you can look at your quarter over quarter data or your year over year data, but you can also look at it against peers, which I know they do in study groups and benchmarking, and also national data that's available through Opus and other sources. And then Ari Cutler of Arco talking about the difference between a customer that's using loyalty and rewards versus one that's not. Spencer touched about that a little bit regarding the larger companies and how they're able to drive sales through loyalty members. So we're going to get out of retail and wholesale fuels and all things convenience store related, and I'm going to take us through an update on propane M&A. So similar graph and table to one Spencer walked you through previously in terms of retail and wholesale fuels, but propane here. So again, the criteria I'll quickly summarize. Had to be a North America-based transaction. Vast majorities are U.S.-only operations. Propane business had to be the predominant part of the overall enterprise. Includes transaction of all sizes. And we see a number of smaller deals in the propane industry relative to definitely the convenience retail industry. So to summarize here a bit, over the last decade, we've observed 495 transactions, so call it an average of about 51 a year. And there's been 160 unique buyers, so roughly one unique buyer for every 3 transactions. So still highly fragmented in terms of who's doing M&A activity. And then in terms of the more recent years, you can see 24 and 25 were below the long-term average of 51 with 40 and 45 deals respectively. And if we look back 3 more years, so a total of a 5-year look back, you can see that 21, 22, and 23 were above the 51-year average, averaging anywhere from totaling anywhere from 55 to the high point or high water mark of 75 deals in 2022. So we've been roughly 10 to 20% down the last 2 years. But we've noticed if you take a look at the bar graph for 2025, as Spencer mentioned in the other industries, you can see that increasing quarter over quarter. Here we've laid out some of the names, logos, if you will, of some of the larger companies in the industry. Not all of these are acquisitive. We see Star Group and Suburban as the U.S. public companies, the most acquisitive. In the bottom, we have financial sponsors and their portfolio companies. They've been very acquisitive lately. In terms of large private regionals, probably Blossman and Perico. Blossman in the southeast and south, Perico in the northeast being the most acquisitive. Moving on to slide 22 here, mentioned private equity or financial sponsors on the previous slide, and Spencer talked about that as well. Here we've graphed their activity over the last decade in the propane industry. I'll just quickly point out private equity here down at the bottom. If you look at the dark blue sliver of the pie in 2016 was 13%. That's doubled to 26% as of 2025. And you can see public company has shrunk roughly 10 absolute percentage points from 26% to 15%, and private company is relatively unchanged if we just round it off at 60%. So observing the private equity companies and private equity funds doing more M&A, and that's taking share from the public companies that have been more stagnant with M&A.
Jed, I want to hit, I'm sensitive to time, so I'm going to hit a couple slides real quick in lubes so we can turn it over to Jim and Noreen, okay? I think
Sounds
we're
good.
Probably over, okay. Let's just go real quick to slide 25. This is just the activity in lubes, M&A, based on how we pretty much put every deal on here we see. It's actually been up in 24 and 25. There's been more consolidation. Smaller lubes players are selling, getting out and selling to larger typically. And at the bottom, you can see some of the bigger consolidators, all of those besides Parkland, which has been acquired, but are backed by private equity. And there's another new roll up by Plexus Capital. The company's called Ace Solutions. They've become really active too. The next slide just shows the decrease in, well, in industrial. Industrial has been pretty good in lubricants, but PCMO and HTMO, both categories down. I think that's no surprise to everybody. And this shows the cumulative decrease or decline since 2001. But if you look at the next slide, which I think is interesting, there's been more interest in, PCMO has actually gotten some life lately, and especially with oil change, chains, retail chains out there. So PCMO demand has stabilized, and that's due to really two main factors: elimination of the EV tax credit, that tempered EV adoption. So you can look in Q3 of 2025, we had so many EVs bought because of, the $7,500 tax credit was being eliminated. And then the Q4 bar is an estimate of how many new vehicle registrations for BEVs there will be, and you can see the decrease. So a lot of lube change or, retailers are excited, but what really drives that is, if you look to the right, the oil change interval, you can see that oil change intervals had been going up a good bit since 2017, but the second derivative, the rate of change, has slowed, and it's starting, now it's like 5,100 miles, only like gone up to 5,300 miles the last couple of years and kind of holding. So that's now stabilizing, and the margins with synthetic oils are very good. So the market has really rebounded for the lube change operators out there, and or the oil change operator, what do you want to talk about, but for passenger cars. So it's actually been an interesting situation that's happened over the last few months, or years, a couple of years, I should say. So that's it. I think, Jed, we should stop there and give Jim and Noreen enough time to present.
Yeah, sounds good. Thank you so much, Spencer and Sean. And again, these slides will be left behind for you so you can do more investigation into them. I know Spencer and Sean are available for any questions, after as well. And thank you so much. As we turn to Jim and Noreen at Winthrop and Weinstein, I'm really excited to have you guys on the call here today to talk with us a little bit about succession planning. How do we plan for both ownership succession as well as leadership succession? A bit about Winthrop and Weinstein: they provide comprehensive legal counsel to owners, distributors, and operators across the downstream energy sector. They work in a lot of different verticals, but have a whole division that's dedicated to our industry, which makes them special. And Jim and Noreen are the people that are really intimate with our business. So I'll turn it over to you, Jim, to tell us a little bit more about succession planning.
Thank you very much, Jed. I just want to make sure you can hear me. We've had some technical issues today.
Yeah, you sound good.
Excellent. Okay. Thank you very much. As Jed mentioned, we've had the pleasure of presenting here in this to this study group for many years with our Matrix friends, and we're happy to be back again this year. Appreciate you having us. What we're going to be talking about today is, at a fairly high level, is succession planning. Obviously, the name of the presentation. I think a lot of people, when they hear that term, they think of things like trusts and wills and other estate planning vehicles. And while that certainly is, part of the overall picture, what we're going to be talking about today is a little bit broader perspective with a focus on business successions and strategic planning. And again, with an eye mostly toward family-owned and other closely held businesses. So succession planning, hard to define. It's not really a one-size-fits-all approach, and needs to be tailored and set up very closely in connection with the goals of the owner or the owners of the company. Those goals might include, for example, tax considerations, assessing potential capital gains taxes, gift taxes, estate taxes. Goals might be family considerations. Is there a next generation of family members that might have interest in taking over the business? They might be ready for it. They might be, suitable in terms of their capabilities. All kinds of family considerations come into play frequently, with that often being sort of plan number one for lots of companies in this space. Other types of considerations as you're looking at your goals might be employee considerations. Is your company one where it would make sense for the employees to own the company? Or if not to own it, would it make sense for the employees or certain key employees to stay in place and manage the company after a transition? And then as you are sort of setting and monitoring and changing your plan over the years, do you need to be thinking about retention of key employees along the way? And then, of course, financial considerations will also be part of establishing your goals and thinking those through as you come up with a plan. Is the goal just to maximize value? So a variety of goals that are really going to be tailored to each individual situation as you start thinking about your own succession and business plan. Sean, we can move on to the next slide, which asks the question, what if I don't have a business plan? What are the ramifications of that? So even if you kind of have gone through the goal setting exercise and determined what your goals might be, like a lot of things in life, if you don't have a plan, you're less likely to achieve those goals. So being intentional and purposeful from the start and acting that way along the way is critical to putting a plan in place and making it fit the situation. And of course, it can change over time. So we always advise our clients to be thinking about these things as early as it makes sense and to be revisiting the plan. So diving in a little bit to some more specifics on ramifications of not having a succession plan in place. Family problems are a potential issue that you may bump into. Are there expectations to take over or inherit the business? Are there varying, interest levels, capabilities, egos among various people within the family? These are all things that should be fleshed out as you are kind of setting and rethinking your plan over time. Business problems. At some point in time, if there isn't a clear answer to the question of what's next, that in and of itself could be a distraction in running the business. Forced sale of the business. Without a plan, that's probably the default scenario you're going to find yourself in, is now what do we do? We didn't have a plan and something occurred, maybe there's a death or a divorce or who knows what, that puts you in a position suddenly where the only real way out or forward is a forced sale of the business. And that, it's just not ideal. It's disruptive. You may minimize your ability to maximize value, if you're in this forced sale situation. Excess estate taxes without the right plan in place. If the business value is high enough, it could end up flowing through the estate and leading to unnecessarily high estate taxes without the right planning. And then, of course, just failure to achieve your goals. If you don't have your plan in place, you're less likely to get there. You're less likely to maintain that family legacy or maximize tax benefit, etc. All the goals we had talked about before. On this, finally, wrapping up this slide, according to SCORE, which is a nonprofit organization that primarily focuses on entrepreneurial and small and family businesses, 30% of family businesses continue into the second generation, only 12% down to the third, and only 4% to the fourth. And those that do continue on into that second, third, and fourth generation, usually it's because of good planning up front. And then Noreen will start to dive into a couple more details and sticks and stones here on what a succession plan should include on the next slide.
Fabulous. Well, thank you so much, Jim, for that introduction, and thanks to everybody here, both on the panel and also who's joined the webinar. Just to confirm, can everyone hear me?
You sound good, Noreen.
Perfect. Well, so as you know, we look at it, really there's a question, well, what exactly does a succession plan include? And I would say there are two principal buckets. The first is management succession planning, and then the second is ownership transfer planning. And we can go to the next slide here. Management succession planning really looks to, do you have the right people in the right seats? Such that, this is particularly the case if this is a business where the owner may be integral to the operations of the business, such that, if the owner were no longer in the picture, that the business would carry on successfully and, would be able to continue to operate, smoothly and continue to grow. So, critical things here, are you looking at development, training, and support of successors? One thing we have seen is that if there's an unprepared management group, or if this isn't attended to early, that can trigger a serious, significant loss in value of the company. And part of this goes towards looking to delegate authority and responsibility to those successors before it becomes necessary, such that there's no one person that's so integral to the operation, or no small group of people. That the business will lose significant value once they're out of the picture, they retire, et cetera. One thing we see some of our clients do that are looking to can move forward with succession planning like this is bringing on some outside either directors or advisors just to give unbiased perspective, advice, and expand the group of people that is able to weigh in on the challenges of the business. And then the last point I think is really important. I think a key element to management succession planning is making sure that the key management team members have some skin in the game. Their interests are aligned with the interests of the ownership group. You'll see that when private equity groups buy businesses, one of the first things they do is they establish a profits interest plan or a stock option plan, some sort of an incentive equity plan to make sure they're rewarding and incenting the key people to engage in the right sorts of behavior and activities that they want them to. And that's not charity, that's smart business. That's making sure that you're aligning the interests of management with the interests of ownership. You go to the next slide.
Noreen, I'll ask you along that line while we're moving to the next slide. Key person life insurance, where does that fit in?
I think that's a fantastic question. I think that can fit in one of two ways. I think key person life insurance can fit in the case just of, hey, our key CEO dies, let's get some amount of life insurance so we can stabilize the business. We've got money to go out and recruit somebody else who's really good. So I think it can help stabilize the business, pay off debt of the business perhaps, if a key person dies. And then the other tool it can be used for is actually for a buyout strategy. And that one I think is even the more powerful of the two, which is, let's say we've got two business owners and, one business owner buys the policy on the other owner's life and vice versa. Then if either of them, walks outside and gets hit by a bus the next day, there's liquidity to buy that person's interests out. It's good for the family of the person who died. They get liquidity. and it's good for the business and for the other owner because they can buy that person out. So that's a great question, and I think absolutely life insurance can be part of the puzzle there.
Thank you.
And then moving to the ownership transfer planning, here, I think a couple things. Really, you've got to be thinking about the best interest of, the family of the owner or owners, and also of the business. So, really, it's a question of, on the management side, who will operate the business, and following a retirement, following a death, and then who will own the business. And this is really one of the places where the business planning touches with the estate planning. And there are a lot of really interesting strategies you can employ kind of in an overall estate plan. I'll just touch on a couple of them, and maybe let's flip slides here. From a big picture, in 2026, the federal estate tax threshold is $15 million, which means a husband and wife can transfer about $30 million of value tax-free to their heirs. There's an annual federal gift tax exemption of $19,000 where you can transfer, up to $19,000 per person to various individuals. And then, also there are a lot of state taxes as well. For instance, we're based in Minneapolis, and Minnesota has a $3 million estate tax exemption. So, I would say, especially for states with state estate taxes, almost all business owners get caught up in having to do planning for estate tax, and even a lot of successful small businesses are triggering these federal estate tax thresholds. And I can say there's a tremendous amount of planning you can do early on in terms of creation, say, of voting and non-voting stock, where you can retain control within a small group, but then gift non-voting stock out of your estate. There's an ability to take advantage of certain discounts if you are making, say, minority transfers of non-voting stock, which is a strategic way to get value out of your estate if you think you are likely to be, over one of these estate tax thresholds. So I would say, this is something I'd say work with a skilled estate planning attorney and also potentially a business planning attorney on these. We frequently are implementing these sort of in conjunction with our estate planning group, and there's a lot of value that I think that you can achieve if you plan early. We can just flip to the common succession plans on the next slide. So few common succession plans, and we've got 4 here that we've identified that are the most common. The first is, the business being sold to an unrelated third party. That would be, taking the business to market, usually hiring, an investment bank to help you market the business, and then, selling to, whoever the top bidder is. The next 2 I'd say are linked, and I think Jim is going to talk about them sort of in conjunction with one another. It's either transferring the business to some family members of the owner who will continue to own and manage the business, or possibly transferring the ownership to family members, but the business actually to non-family. And then the last item in this category is actually selling the business to non-family employees of the business who could manage the business. So that can either be directly or through an ESOP. And I think Jim will take you through the first couple of these common succession plans.
You there, Jim?
I am here and talking to myself because I forgot I was on mute. So hopefully you can hear me now.
Yeah, I can hear you good.
So great. One of the more common, obvious successions here is to sell the business to a third party. In general, oftentimes that might be the best way to maximize the total value of the business compared to some of the other options. It sort of substitutes the business where perhaps if you don't do this, then the next generation is going to be in business together. And, so if that works, then you won't maybe do this, use this option. But if not, then it substitutes that for liquidity. So that's probably one of the main inflection points that a lot of businesses get to when they're talking about successions is it family or is it third party? So, a disadvantage of going this route and selling to a third party is oftentimes you're going to lose control and possible loss of legacy. So to the extent that those things are more important to you, we go back to the goal setting. then you may want to rethink which way you go, and if maintaining legacy and control and family involvement is more important, you might sacrifice a little bit of value, but you're achieving your actual goals. Some other things to consider here, there are obviously, as Spencer and Sean walked us through, different types of third-party buyers or strategic buyers, financial buyers. Oftentimes, if you can't, when you're going through a transaction to sell to outside the family team or outside the current ownership group, having an independent management team in place, and a strong one, can really help bifurcate the sale piece from continuing to run the business and minimize disruptions and distractions along the way. So it's important to have an independent management team in place, and that's going to be even more important if you're selling to a financial buyer. Something else to consider is whether in this type of transaction you would build in some rollover equity or incentive equity. Maybe another way to increase the price a little bit by taking less in cash, but staying in the mix with some equity in the buyer, which provides potential future upside even beyond what you got when you sold it to begin with. Probably a little bit more common where the sellers are going to stay on with the management team, but can be built into a lot of different structures. On the next slide, we're going to pivot to a sale, and this is kind of the next two slides, but we're talking about a sale of the ownership to family members. And on the first slide, those family members will stay in the business and operate it. On the second slide, they'll own it, but management will be by employees. So a lot of commonalities and similarities, as you can imagine here, in terms of advantages. There could be, if this type of sale is structured right, as Noreen was alluding to earlier, and if it's addressed early enough, there could be some strong tax advantages to transferring ownership in a kind of progressive manner over time. And also, you're just preserving the family legacy. So the next generation is able to carry on what the prior generation built, which is often the driving force behind this choice, whether they stay in and operate or not. Disadvantage really comes down to who is there, who's that next generation, and hearkening back to basically readiness, their interests, their capabilities, and then what are the various egos of that generation and how do they align? Oftentimes you're going to have different members of that generation that have different skill sets and different egos and different interests. So there can be a lot of work to be done there, but that's where kind of hitting it and talking about it early really helps. And again, I won't spend a lot of time on this, but Noreen had kind of alluded to the possibility of structuring kind of a voting equity and non-voting equity structure. So you could, if you've got varying family members with varying different levels of interest, you could structure control in a certain subset of that group while maintaining economic benefits for the broader group. And then just on to the next slide, again, the distinction here is you're still transferring to the ownership to family members, but the management is going to be at the employee level. Obviously, this works best if you've got a strong management team in place and also family members that are not super interested or qualified in running the business. I think this is one of those areas where oftentimes bringing in outside voices like outside board members early in the picture can give you perspective. Otherwise, it can sort of be an echo chamber if it's all family, all the time. I think getting some outside voices and thoughts and perspectives can really help in making decisions about should this go to the next, should this be a family transfer, and if so, who, and should they stay in the management seat or not, or if it's some combination, who should be doing what. It's helpful to get some outside thoughts on that. Let's see, I just want to be, we're just about out of time here. So maybe Noreen, do you want to hit the last piece and wrap up?
Yeah, absolutely. So I think we can just flip to the next slide. So then the last item here, and I won't belabor it, it would just be a sale of business to non-family employees. And that can either be done directly through a purchase from a small ownership group or a sale to an ESOP. And just a flag, a sale to an ESOP has a lot of interesting tax benefits, both for the seller and also for the, the employees that are able to purchase through that. And I think, with that, we can just kind of wrap up. And I think on our last slide, Jim and I tried to distill what you can flip to the last one there. Yeah. What we would distill as the key takeaways here. I think the best way to make sure your business successfully, transitions, whether it's to the next generation, whether it's just, to another group of, owners, business team members. I think it's first be clear on your goals. Assemble your team and do that in advance. And that should be a mix of financial advisors, legal advisors. I think the more you can bring smart, talented advisors around you, I think the better. Be proactive, not reactive. I think taking steps well in advance of when you're looking to exit the business is smart. And just realize that, no decision or not taking action is also a decision. But we think with smart and proactive planning, I think you can get a much better result, both for yourselves personally and also for, the long-term health and success of your business and the future of your family and employees. So certainly appreciate everybody's time here. Thank you.
Yeah, thank you, Noreen. Thank you, Jim. 2 quick questions before we wrap up. One is on ESOPs. When do they tend to work well and when don't they?
I think, I think ESOPs is a huge topic, and I'll let Jim jump in with any thoughts. I mean, I think the times when they work best are, when the business is really focused on, the owners are focused on the legacy aspect. So I think the best thing about an ESOP is it's an effective way to transfer ownership, not just to a small group of people, but to a larger group of people. It doesn't necessarily maximize, the immediate dollar return of a business the way a sale to a third party does. But often there may be an opportunity for the owner to, either defer capital gains or maybe even, avoid capital gains on the sale. And I think, the other probably biggest advantage is if the owner has a longer time horizon, it often involves a component of financing. You are going to get a big, check immediately on closing. Often you maybe get a portion of it, through a financing arrangement at closing, but then there's often a seller financing component. So I think flexibility on when the owner gets paid is also helpful.
Thank you for that. And last question, divorce. That's always an unfortunate topic, but especially when bringing in a minority shareholder, could be a key employee, or transferring it to the next generation of a family member. It feels like sometimes it gets transferred to that next generation. They go through a divorce and now the business is impaired. Is there any advice on doing post-nuptial work before making that transaction?
Yeah, Noreen can chime in as well. I would just start by saying I think this is one of the main reasons that we always take a really close look at buy-sells within, shareholder control agreements, operating agreements for companies to address that that among other situations is to cover it there. That's the best way to handle that up front so that you're not wrapped up in some court proceeding. Sorry, Noreen, I think you had something else to chime in with there.
So I think the buy-sell answer is a great answer. I can say I do have a few clients who have insisted family members either, they say, hey, we've got a family policy of signing prenuptial agreements or postnuptial agreements. So I think that's a tool as well. But I think the more common solution is a really strong buy-sell that I think both can disincentivize, say, the ex-spouse from going after the equity if the only way they get the equity is that, then there'd be a buy-sell at a discount or something. And it also just ensures that, you don't end up with a aggrieved ex-spouse owning a portion of your family business. So great question.
Yeah, well, thank you guys so much for your time on this. For the audience, I know we'll send out your contact information or the panelists' contact information. If you have other questions, there's a lot in here. All of our panelists are happy to visit with you. Just want to say thank you for joining us today. And also just appreciate the knowledge that our experts shared here. Before you go, as the audience, I'd like to just remind you to check out our SG Voices website for more valuable content on there. We have some articles, some webinars that we've done in the past, and other industry-specific resources. You can also stay updated on our next events coming up. Mark your calendar for March 12th. March 12th, we'll have a webinar with McCloskey Excellence Institute and Go Happy, talking about frontline employee engagement and building workflows to ultimately make your teams more efficient. So always appreciate your feedback. We want these things to be educational and high value. There'll be a very short survey. You can fill out 2 questions as you sign off. Thank you again. Hope you have a great day. See you next time.
Thanks, everybody.
Thanks, everyone.
Thank you.